Welcome to Growth Investing Mastery. This video will look at our June 2025 portfolio review. As a reminder, this is not investment advice or recommendations to buy stocks. The topics for this video will include advantages of this style of growth investing, and then we'll look at the importance of multi-baggers in our portfolio. Next, we'll look at a curveball we got in a telehealth investment. And after that, we'll look at current allocations, results, and then a review of companies we own. And I did a mid-month earnings review where I looked over the transcripts of the companies I have. So there's a lot of new thoughts since the last portfolio summary. We'll then look at companies I sold, companies researched, and finally a summary. Taking a look at our allocations for the month, we have 4 high confidence positions. Our highest allocation is Sezzle with symbol SEZL at 17.6%. Next up is AppLovin with symbol App at 16.2%. That's followed by Astera Labs with symbol ALAB at 16%, and then Reddit with symbol RDDT at 15.9%. We have 2 medium confidence positions. First is Paymentus with symbol Pay at 11.2%, and that's followed by Hims and Hers Health, symbol HIMS, at 11.1%. We then have 4 low confidence positions, which include Cineverse CNVS at 3.3%, Paysign with symbol PAYS at 2.7%, Nova with symbol NVMI at 2.4%, Dave with symbol Dave at 1.8%. And then there's 2 starter positions, Credo with symbol CRDO at 0.9%, and Champions Oncology, CSBR at 0.8%. We sold 1 company this month, which was Remitly, and we added 2 new positions, which are those starter positions of Champions Oncology and Credo. Additionally, we trimmed Sezzle and Reddit because they both had really big run-ups in the month, and it made sense to take some profits there. And we used those funds from Sezzle and Reddit to add to Paymentus, Nova, Cineverse, AppLovin, and Dave. Additionally, companies such as Paymentus and HIMS haven't had a big run-up, and they're right in that medium confidence position range of about 11%. So I do like that the middle portion of our portfolio is filled out a bit there. And then we have 4 low confidence positions and a couple starters. And you'll notice the composition of my portfolio has changed a bit since the last summary. We now have 12 positions, and I typically recommend 7 to 11 stocks, so I would like to sell 1 or 2 companies if possible. Taking a look at our results, in 2024, we were up 146%, and in 2025, we're up 35% year to date. The cumulative return since January 2024 is 232%. So you can really see the power of compounding now. Getting an extra 35% on top of 146% returns really adds to our results quite a lot. And when we compare to the NASDAQ, we're up 35%, where the NASDAQ's up 5% on the year. And the big results are mainly coming from Sezzle, which has really been carrying our portfolio, and also from Reddit and Paysign, which are both doing well. And here we have a graph from my main account, and you can see that the swings are really huge in 2025. We were down quite a bit in April, but we've made a really strong recovery since then. Let's talk about some of the advantages of this style of investing at Growth Investing Mastery. One of the big ones is that this style of investing allows for breaks and vacations. We don't need to always be on, so we can take time off when needed. Our strategy revolves around earnings season, and that's the most important part to focus in when our companies report results. In the off-season for earnings is a good time to start finding new companies. Part of the reason is that other companies have just reported results, and we can try and find which companies really put up strong quarterly results. The approach recommended by this channel is low stress, and it's sustainable as well, meaning we can do it for the long term. It's not an approach which results in burnout typically. The strategy completely avoids macro and politics-based trading. This simplifies the approach compared to many investing styles. And it also keeps stress low, not needing to consider macro or politics in our strategy. We stay fully invested always, and this allows us to focus in on company results. We avoid guesswork and predictions in our approach, and we let company results drive the majority of our decisions. The strategy gets superior results, and that'll be shown over time as this channel continues. Let's now look at the importance of multi-baggers in our strategy. One stock performing well can drive returns for the entire portfolio. The company Sezzle in our portfolio started as a medium confidence position a few months ago, and it's now our top holding with a massive run-up. I've been trimming the company multiple times as it has been rising. However, I don't want to kneecap the position too much. We first mentioned this company on the channel on April 11th. The stock was at $36 per share in our introduction video, and now it's at $181 as of the most recent price, which is up 403%. Something important for us to consider is that getting multi-baggers allows us for getting it wrong on many other companies. And if we get just a few multi-baggers per year, it will drive the superior results that we're looking for. Part of our strategy as a company starts to dominate our portfolio is to trim it as it goes up, and we'll hold until we reach a disappointing earnings result. Let's now discuss a curveball our portfolio got thrown in telehealth this month. One of our top holdings, HIMS, went down 35% on June 23rd when Novo ended their deal. And Novo came out swinging very hard against HIMS, claiming personalization is not eligible for compounding, and they accused the company of fraud. This was very surprising because in the HIMS earnings report, they sounded really enthusiastic about the partnership, and they mentioned things like eating meals together with the leadership team from Novo. Novo alleged that HIMS used foreign source materials, even though some people observed that Novo sources the materials from China themselves for their product. Additionally, Novo kept deals with competitors such as Ro and LifeMD with symbol LFMD. So this does seem like a direct shot at HIMS. And I used to own LFMD back in April, and I mentioned here there's a potential for mega tilt as the stock we sold rallied while the one we hold is going down. And I avoided this type of tilt by not checking prices as the stock was crashing during the day. And we want to view a company going up, which we used to own, as a positive validation of our process. I'll use an analogy from fantasy football. When I first started playing fantasy football, I would get upset when one of my bench players did really well and got a lot of points. But those points didn't accumulate to my point total since those players were on the bench. And a friend pointed out to me that having a bench player do well in fantasy is still good because we still own that player. While I don't own LifeMD anymore, it is an encouraging sign that stock is doing well. And we can use the strategy of injecting logic, which I've mentioned before in psychology videos. In this case, we can remind ourselves that our businesses can go down for a variety of unpredictable reasons. And our play in this situation is just to hold and wait for earnings coming up. I typically prefer not to add on negative news, even though it is tempting sometimes, and the price for HIMS has recovered a bit since this story. And one key point is that holding no position over 20% allows us to absorb monetary and psychological consequences of a stock going down massively in one day. And one last important tip is to not fixate on a single stock. It's easy when a stock goes down 30 or 35% to become obsessed with that story and fixate on that stock specifically. But the issue is we end up ignoring our other stocks, which may require some attention. Now let's take a look at companies we own. And the first one is Sezzle with symbol SEZL. While this company is my highest allocation position, it's not my top confidence position, but it's had such a big run up that it's ended up at the highest allocation. And the company's product is a buy now, pay later solution with high customer loyalty. They've been on an incredible run post earnings, and the market is really warming up to these types of alternative banking stocks. One quote the company had was that the shopping browser extension, price comparison on products, and auto couponing is all done with the mindset of increasing the value provided to our consumers, which in turn should increase retention and loyalty. The CEO mentioned that getting a $15 auto coupon creates a very positive impression for the consumer. And now that Sezzle's business has gained a lot of momentum, they're focusing on the larger side of enterprise merchants. The company is pushing into new categories where buy now, pay later has been late to be adopted. Regarding the on-demand product, management said, what we're seeing is monthly sequential growth right now, which tells you we've really got a winner of a product on that. They continued, there's a low barrier to entry, which allows us to bring more consumers into the funnel, which we love. And one analyst commented, it sounds like you were surprised by how strong, how sticky the monthly paying subscribers were. Lastly, the premium on demand allows for the card to be used anywhere now. And my strategy for dealing with this position has been to trim repeatedly on the massive run up as the stock is up over 400% in the last few months. The next company we own is AppLovin with symbol app. Their product is ad tech, and they describe themselves as a performance marketing platform. Ad spend on the platform has quadrupled since they launched Axon 2. There is a flywheel effect for advertisers, and the company is launching their self-service platform for the web pilot in this quarter. Management said we've seen great performance so far in our web advertising pilot. Currently, the pilot is only US based, but the company said they can flip a switch to make it go global. And management added it's quite likely web could make up over 10% of revenue for the year. That comment is pretty interesting to me because for the first 2 quarters of 2025, they haven't had that much revenue from the pilot, but they're projecting now over 10% of revenue from web. The company mentioned advertisers need to prove themselves, and marketers build budgets over months after seeing results from ad tech products. The company is focusing first on mid-market web advertisers, and there may be later upside adding bigger players in later. Some statistics to note for the quarter were revenue was up 40% year over year, while adjusted EBITDA was up 83% year over year, and free cash flow was up 113% year over year and 19% quarter over quarter. So we can see from those metrics, both profitability and cash flow are stepping up much faster than revenue. And there were again more short reports against AppLovin, and one was a second report from the same company who had done a short report 3 months ago. But these short reports, they just aren't having the same downward effect. And many investment banks have come out and said that these short reports are bogus, and they reiterated their price targets. So I'm not too concerned about these short reports right now. Our next high confidence position is Astera Labs with symbol ALAB. Their product is a hardware and software platform for rack level AI connectivity. And it's a holistic solution, not just for silicon products, but also for hardware and software. The company recently announced they are part of NVIDIA's NVLink Fusion ecosystem, along with other vendors being added to that platform. When I saw this initially announced, I thought it was exclusive to Astera, but I understood that Marvell and Credo are also part of NVLink Fusion. And the NVLink Fusion ecosystem is for connecting disparate systems in the data center, which might not be able to connect on NVIDIA products alone. The company mentions Scorpio PCB switches and Aries 6 retimers are going to shift to volume production in late Q2. Additionally, the company is shipping Scorpio pre-production volumes for their Scorpio X series in late Q2. The UA Link Consortium will enable the industry to move beyond proprietary solutions to scalable and interoperable AI ecosystems. And Astera is a leading member of that UA-Link consortium, which is really good for the company. The Scorpio product provides packet-level visibility for increased observation of data center traffic. System complexity and larger clusters create substantial dollar content opportunities, the company said. And as I was rereading the Astera transcript, I noticed they mention they continue to see large and growing opportunities for general purpose compute. So it's not all just AI growth. And this general purpose compute includes the transition of data center server CPUs to support PCIe 6, and that gives higher average selling prices for Aries, which is also great for the company. They mentioned the Taurus product line continues to see growth on general purpose compute platforms as well. The Leo CXL controllers and Scorpio Smart Fabric switches ship pre-production to qualify for platforms. And the company expects volume deployment in mid to late 2025 for those two products. The company also mentioned the Scorpio X series is greenfield TAM with multiple product lines. And lastly, since Astera is so close to the customer on designs and ramping up, they mention, we see a lot of stuff, and that helps them provide accurate guidance. What I really like about Astera right now is they're saying that production is ramping up in Q2, and the second half of 2025 is projected to be a huge ramp up even further. The last high confidence position we have is Reddit with symbol RDDT, and the product is social media for community. Reddit recently announced they launched something called Reddit Community Intelligence. And this includes two products. The first is Reddit Insights Alpha, which is real-time insights from discussions, and marketers can use those discussions. The second product is Conversation Summary Add-ons, and that's also an alpha product. It dynamically adds positive Reddit comments. And my understanding is that could be added to a web page or app to show positive reviews. On this latest earnings transcript, I recently caught that they said there's 400,000 users playing games and other interactive experiences on the dev platform in Q1. The ad stack focus for Reddit is 1, driving performance, 2, improving usability, and 3, increasing productivity for the sales force. One statistic that really stands out is that total adjusted costs are up 19%, and that's versus 61% revenue growth. So revenue is growing much faster than costs. And the company is seeing strong international growth, with the UK and EMEA leading the pack. The company said the scale channel, which includes mid-market and small businesses, was a growth driver in the quarter. One quote was that users sometimes want subjective, authentic, messy, and multiple viewpoints from Reddit. And the CEO said that Reddit is an alternative to AI search cancers. And I thought that was a really interesting choice of words, that the CEO sees AI negatively in some aspects. And that leads to the Answers product, which unlocks a new query on the internet with a subjective answer. Management is hearing from advertisers that Reddit is competitive on ad spend. Regarding data licensing deals, there's early feedback that the companies love the raw data. Reddit went on a really big run up this month, so I ended up trimming some of my position, but it's still a very high confidence position for me. Our next company is Paymentus with symbol Pay, and they are medium confidence. The product is a SaaS-based payment collection platform. And I mentioned SaaS there because I think a lot of investors have a misconception that this isn't a SaaS product. Part of that reason may be because they get a majority of their revenue from transactions. One big standout about this company is that operating expenses only grew 13% year over year, while revenue grew 49%. And management mentions they can use OpEx as a lever on marketing and acquisition. One analyst noted through backing out the numbers that contribution profit is growing faster in the second half of the year. The company mentioned they're seeing higher transaction activity from both new and existing clients. Additionally, the company achieved a record $41 million in free cash flow for the quarter. They said they ended Q1 with a substantial backlog, strong pipelines, and that bookings were good. One direct quote from management was, "We're getting even more exciting for us as a team here as the business is scaling and we are generating more EBITDA dollars." And signing large customers is helping get other large customers as word is spreading about their superior product. Cash for this business is increasing as they have $250 million of cash on the balance sheet and no debt. The valuation for Paymentus at a $4 billion market cap seems really attractive to me as they have over $250 million of revenue and they're profitable already. For example, if I compare that with Sezzle, Sezzle has $105 million of quarterly revenue and a $6 billion market cap, which is 50% higher than Paymentus. And usually SaaS gets higher valuation than fintech, but I think there's some market skepticism on payments and gross margin for Paymentus. The stock has been a laggard in my portfolio, but since I've owned them, they've delivered 2 really strong quarterly results, and I'm expecting them to deliver another strong result soon. Our next medium confidence stock is Hims & Hers Health with symbol HIMS. And we discussed them a little bit on the slide about the Curveball in telehealth. Their product is a telehealth provider with personalized medications. And Novo recently canceled their partnership regarding Wegovy. However, the business does not depend on a Novo partnership. And it seems like Novo threw a temper tantrum that Hims would not place their product at the top. But the really strange thing is that the latest earnings transcript mentions deep collaboration and an extended roadmap with Novo. Hims also acquired an at-home testing provider for making blood tests more accessible to everyday users. And they're also expanding into peptides, and one quote from the earnings transcript was, "Peptide innovation is expanding very, very rapidly." Peptides address pain management, recovery, and generalized longevity. The company has 2.4 million subscribers, which is up 38% year over year, and that compares to 111% revenue growth, although a lot of that revenue growth is coming from GLPs. One standout statistic was that adjusted EBITDA is $91 million, and that's triple what it was 1 year ago. Marketing spend is only 39% of revenue for Hims right now, and that's down from 45% last quarter and 47% last year. Another small fact I picked up on is that the company's lease for the larger Arizona facility means the nationwide square feet for their facilities goes from 400K to 700K, a 75% increase for their production facilities. And my main concern right now is, will the FDA allow Hims to continue to accept the style of personalized compounding that Hims does? Hims explicitly states they are not mass compounding and they are personalizing. But if they're personalizing using AI, it might be a very gray area for them. However, my plan is to continue holding till the next earnings and see where things shake out then. The next company we will look at is Cineverse with symbol CNVS. They are a low confidence position. The product is a streaming service platform for movies and series distribution. And this company just reported earnings on June 27th. They're on a little bit of a weird fiscal year. They don't give guidance, but analysts expected 14 million of revenue, which came in at 15.6. And analysts expected adjusted EBITDA of 1 million, which came in at 4 million. Lastly, analysts expected GAAP EPS of 1 cent, and that came in at 4 cents. So profitability landed way ahead of expectations, and revenue was a slight beat. I thought that the company may be able to beat revenue by a bit more, but still I was okay with these results. For the next quarter, analysts have really low expectations. They're projecting revenue of 10 million, adjusted EBITDA of negative 1 million, and GAAP EPS of negative 17 cents. And that kind of estimate makes no sense to me. I think that Cineverse will beat all those numbers easily. They have one big film coming out soon in August, which has the potential to greatly beat those numbers. However, for the two analysts who cover the company, one has a price target of $9 and the other has a price target of $10, which would be over double from where the stock price is currently. The company is going through a bit of a corporate restructure to divide the tech and media components of their business. And I think this plan makes sense as they plan to expand more into tech. The company has 3 headline films slated for release coming up. The first one to come out will be The Toxic Avenger in August. On the balance sheet, the company has $13.9 million of cash and 0 debt. So the market cap for this company is $75 million, meaning their cash balance is about 18 or 19% of their market cap, which is pretty significant. And the company stated bluntly, we continue to believe that our stock price is undervalued with significant upside. You don't typically see management comment that strongly on stock price, but this is pretty encouraging that they have the same take I do, that this company seems undervalued for what they're producing. They mentioned on the latest earnings transcript, the Cineverse channel on Amazon is growing 30% per month since launch. However, I don't know when it launched or how much revenue this is, so that's an open question for me. The C360 proprietary ad platform signed some new partners recently. These include Sony, Expedia, Hulu, and Disney. And the company is currently putting their Matchpoint software through testing right now before they turn it into a fully fledged SaaS product. That's really encouraging to me that this company is talking about building a SaaS product, and they're only a 75 million market cap. So if they're able to deliver on that promise, it could present a lot of upside. Discussing the Cinesearch product, management said accuracy and breadth of the content recommendations that one receives via Cinesearch are far superior to anything else in the market. And I did add a little bit to my Cineverse position before earnings. I mentioned I thought they could deliver a little more of revenue, but I was pretty pleased to see the profitability come in much higher than expected. So I'm planning to hold this and probably through to the next earnings. And my hope is that the Toxic Avenger movie can drive results for the next quarter, so we'll see about that. The next company we own is Paysign with symbol PAYS. Their product is fintech solutions for healthcare and pharma. The stock is on a really nice rally as my position is up about 130% since starting a few months ago. And there's really two sides of the coin to this business. The pharma reimbursement side is up 261% year over year. However, the plasma related business is down 9% year over year. Gross margin in the latest quarter was 62.9%, and that's versus 52.6% a year ago. The pharma side of the business is higher margin, and that's what's driving that gross margin increase. Paysign acquired a company called Gamma Innovation, and they expect this to drive between 4 to 5 million of cost savings. One direct quote was, operating expenses are being revised lower, and this is already a profitable company. The balance sheet has 6.9 million of cash and no debt, and the company's still pretty small at a 390 million market cap. GAAP profitability for a company of this size is pretty rare this early on, and it shows how efficient their business model is. My big concern is that the full year revenue guide of 72 to 74 million is on the weaker side, and I don't have a really good sense if management is sandbagging or how accurate this guidance may be. I am debating to trim a little bit of this position as it's had a huge run up. However, it's not a high allocation, so trimming is not that urgent right now. Our next low confidence position is Nova with symbol NVMI. They are a semiconductor supplier for measuring solutions. Two standout stats are the GAAP EPS grew 56% year over year, and that's versus 50% revenue growth year over year. So profitability is growing slightly faster than revenue. The company said demand for mature nodes remains stable with many new customers joining the ranks. And I believe mature nodes are semiconductors who have a mature manufacturing process already. There is continued adoption of the Nova Veriflex 4 platform, which is an X-ray for device fabrication. The company mentioned they do see a good backlog, and there's a tiny tariff impact where they estimate 50 basis points in gross margin impact. The company has a diversified global supply chain. And I did have an introduction video on Nova for the channel if people are interested to do a further deep dive on this company. The next company we own is Dave with symbol DAVE. Their product is a membership-based digital banking platform. The company recently saw double-digit gains in average revenue per user, which was $171, and that's up 29% year over year. This is in addition to an increase in monthly transacting members. Approximately 60% of originations in Q1 were on the new fee structure, and the company will see the full benefit in Q2. And that's really encouraging that we're already hearing about some upside to be seen in Q2. Conversion rates for new customers are up, and the company said it's all upside from a customer orientation standpoint. The company mentioned they're seeing enhanced engagement through extra cash, and this is deepening relationships with the Dave card. There is an organic synergy between extra cash and the Dave card, and it's faster and cheaper to access credit for their users. The effectiveness of cash AI underwriting and that algorithm leads to more profitable underwriting. And with recent macro concerns and fewer credit alternatives, that serves as a tailwind for Dave. One direct quote was that average revenue per origination was over $13, which we believe bodes well for monetization in Q2 and beyond. Management mentioned they're seeing processing and servicing costs decrease 8% year over year. This is in addition to seeing efficiencies in vendor contracts. On this latest earnings report, Dave raised their full-year guidance significantly. Revenue was originally guided for $415 to $435 million, and they changed that to be $460 to $475. On adjusted EBITDA for the full year, they had originally projected $110 to $120 million, and they changed that now to be $155 to $165 million. My biggest concern with Dave is there's an outstanding FTC lawsuit or a potential settlement that should be resolved in Q3, and that was regarding misleading marketing practices by Dave. Hopefully they can sort that out or pay a small fine for that issue and be able to move on with the business. Our next company is a starter position in Credo with symbol CRDO. They are an AI hardware provider that recently entered the software space. I used to be in this company and then I sold them, but I'm back in Credo after an impressive earnings report. They had guided revenue to be in a range of 155 to 165 million, and they landed at 170 million, which was up 170% year over year and 26% quarter over quarter. The next quarter guide for revenue is 185 to 195 million. And they announced this quarter their new software platform called Pilot. Previously, the company did not have this type of comprehensive software platform. And it's one of the reasons I wanted to buy back in, that they're expanding into the software space. There's an impressive increase in gross margins, as adjusted gross margin was up 354 basis points quarter over quarter and 1,289 basis points year over year. The company mentioned on the transcript there's 2 newer customers that could become 10% customers soon. And I do still have some concerns about this business. When I previously owned this company, it was close to a 10% position, and now I'm at a 1% position, and it's partly because of these concerns still. One really weird thing on the transcript was the CEO did not mention the Pilot software as something new. He mentioned it as something investors should already know. However, the announcement of Pilot was just in May, and I can't figure out at all why he wouldn't give a better introduction for their new software suite. although analysts did mention that it is new. The company's top customer is Amazon, which makes up 61% of revenue, a potentially yellow flag, but that allocation is down from 87% a quarter ago. The headquarters for Credo is in Georgetown in the Cayman Islands, and there's a heavy reliance on Asia for the company. Those two things seem to add some uncertainty from my perspective. Lastly, I believe their competitor Astera Labs seems to be ahead of them on software, which is why I have Astera as a top confidence position and Credo as a starter right now. Additionally, Astera has higher margins and started out more as an AI software player, whereas Credo did more of a pivot to get into their position. Despite all these concerns, it's really hard to find a company that's growing revenue 170% year over year and 26% quarter over quarter. So those numbers are enough to get me interested and get me back in a starter position. The last company I own is Champions Oncology with symbol CSBR. The product they have is Services for Biotech on Cancer Data, and they are a CRO, which stands for Contract Research Organization. They do what's called xenografts, and these are models which preserve tumors, and these tumors can be implanted in mice for research. They have unique tumor models for both drug discovery and development. And since I haven't introduced this company before, we'll do a quick rundown of some stats about the company. They have a 84 million market cap and a trailing price to earnings of 14, so the company is quite cheap on traditional metrics. It's 210 employees with the headquarters in New Jersey, and they've been public since 1986. On the balance sheet, they have cash of 3.2 million and zero debt. The gross margin last quarter was 61%. And what really has me interested in this company is in the latest quarter, they signed a data deal for 4 million of revenue in the quarter. And that money went almost entirely to the bottom line, or earnings per share. However, the deal was a one-time sale, meaning it's non-recurring, but management said there's 2 to 3 deals in the pipeline. What's unclear to me is the size of the deals and the timing. And the company mentions they're looking for recurring revenue, so it sounds like they may have different structures to the deals going on. One additional point is in April of 2025, the company obtained a radioactive materials license. So it sounds like they may be expanding some of their products. My biggest concern for the business is the non-data side of the business is 12.5 million of revenue in this latest quarter, and that's versus 12 million from last year. So that part of the business isn't really growing that fast. The full year guide is for 10 to 15% revenue growth, and that seems to account for no new data deals. The company mentioned they may raise capital to fund phase 1 and phase 2 trials. Overall, this is an extremely risky company, although they are profitable, but the market cap is really small, and my thesis relies a lot on getting these new data deals. But I don't know how much the data deals will be for, so it's a big question mark, and I'm likely to keep this position small until I know more. There's one company we sold this month, which was Remitly. And when I was doing some research about the company, I looked at their latest earnings press release, and something stood out as a red flag to me. They wrote that the next quarter guidance calls for a GAAP net loss position. And it just makes no sense to me at all that on higher revenue, they would be getting a net loss. This is because the current quarter net income was 11.5 million, and the business sounds to have a lot of momentum. They had also projected revenue growth next quarter of 25 to 26%, which was quite low, even though I expect this company will handily beat that guidance. Comparing to another competitor, Wise, which was formerly called TransferWise, that company has much more profitability, and I'm struggling to see why Remitly is much less profitable than Wise. The CEO was asked about stablecoins, and he was pretty neutral about his take there, but I am concerned companies like Circle, who are in crypto, may have an edge here. The company is making partnerships with WhatsApp and Circle, and these do sound incredibly promising. However, my concern is management was really underselling the WhatsApp partnership, and I don't understand why. The WhatsApp transfers for money are only allowed in Latin America, and management mentioned they want to focus on Latin America first. But they didn't really mention too much about expanding globally, and I'm not sure why that is. And some takeaways about selling Remitly here. I only own the company for 1 week before selling, and sometimes when that happens, it can feel like we wasted a bunch of time researching Remitly and then we just sold it. But it's a lot better for us to discover the bear case early on than to find that out later. So we'd rather sell soon if we find something we don't like. We can always reevaluate the next quarter, and if the next quarter is impressive, we can invest again. The other advantage is we need much less ramp up time on this business if we decide to invest again, because we've already done a lot of research. Additionally, we learned a lot about the remittance market and competitors such as Wise and Western Union. So it's not a completely lost cause to have bought Remitly and then sold them that soon. Let's now take a look at some companies we researched during this month. The first is TSS Inc. with symbol TSSI, and they offer solutions for data centers, including planning, design, and engineering. They do systems integration, facilities management, and procurement. Revenue in the latest quarter was $99 million, up an impressive 523% year over year, with EBITDA of $4.3 million and net income of $3 million. My concerns are gross margin last quarter was 9%, and 90% of the business is procurement. There was even an analyst asking if the business could be potentially obsolete through other competitors' innovation. So I'm not too enthusiastic about this business, but that headline number of 523% year-over-year growth does have me interested. The next company we looked at was LEAT Corporation with symbol LEAT, and they offer personal protective gear for both mountain bikers and motorcycles. They have something called the LEAT Brace Neck Protection System, and that's in the biking space. Revenue was $15.4 million, which was up 45% year over year, and the company's already profitable with EBITDA of $1.8 million and net income of $1.1 million in the latest quarter. The company has a tiny market cap of $52 million with a high cash balance of $12.7 million and just $1 million in debt. The company does R&D based out of South Africa, and they manufacture in China, but I'm not sure of the tariff impact. My concerns are that this company is on the pink sheets, and I'm not sure about their innovation as well. They seem to have a popular product, but I'm not sure on the growth prospects from here, although this company does seem pretty cheap. The next company we took a look at was called Innovative Solutions and Support, with symbol ISSC. They make products for commercial air transport, avionics, and flight management. Revenue was $21.9 million, which was up 104% year over year. But most of that growth comes from a Honeywell acquisition, where they acquired part of Honeywell's business. This company has really strong profitability for being this small. EBITDA was $7.6 million, and net income was $5.3 million in the latest quarter. They have an $80 million backlog, and their product is locally sourced in the US. They mentioned they're 3xing their production capabilities as well. With a market cap of just $217 million, this company has attractive economics so far. And I think I want to wait at least one more quarter to see how this Honeywell acquisition plays out. They did mention there's a supply chain transition as they figure out where the parts are coming from and where they're going to. Let's continue on looking at some more companies we researched in the month. The first is Electrovaya with symbol ELVA. They make lithium-ion batteries, and they're based out of the US for their manufacturing. Revenue was $15 million, which was up 40% year over year, with EBITDA of $1.8 million and net income of $0.8 million. The market cap is $136 million, and the headquarters is in Ontario. There was a pretty strong narrative in the transcript around customers and ordering, but my big concern were that the guides they gave were not raised after the strong quarter, and they're planning additional capex for plant expansion. Another company we looked at was Monolithic Power Systems with symbol MPWR, and they do power management solutions. This is already a fairly large company with 638 million of revenue, which was up 39% year over year. They're fairly profitable as well, with EBITDA of 180 million and net income of 134 million. And this business is pretty mature already. There's a 32 billion market cap. The statistic that got me really interested is their storage and compute segment was up 38% quarter over quarter. Additionally, automotive was up 13% quarter over quarter. The valuation for this style of hardware manufacturer seems quite rich, and the run rate PS is 13, so it's not too attractive from a valuation perspective right now. Another company was Climb Global Solutions, with symbol CLMB, and they're an IT distributor that's connecting vendors to corporate resellers. Revenue was 138 million, which was up 49% year over year, with EBITDA of 6.6 million and net income of 3.7 million. The business does have low gross margins, around 20%, and the latest quarter came in around 17%. US revenue makes up 69% and Europe is 28%. Some pros for this business include improving economics, there's no debt, and the company seems pretty cheap. For cons on this business, I'm not too sure about their innovation or replaceability of solutions. Let's now look at 3 more businesses we researched in the month. The first is KSPI with symbol KSPI, and they're an e-commerce platform in Kazakhstan. Revenue was 1.61 billion, which was up 47% year over year, and EBITDA was 981 million, with net income of 500 million. There's an impressive gross margin of 74%, and the market cap is 16 billion. I had looked at this company about a year and a half ago, and what's impressive to me is they've expanded into fintech, groceries, travel, and now they bought a bank in Turkey, and they're planning to expand into Turkey once they acquire that bank. They did see a headwind this quarter where the government required people to register smartphones, and there were some contraband smartphones. However, they said this is a one-time issue, and that's going away next quarter. This company does have a really attractive valuation when I compare it to other e-commerce companies like Melli or to Nubank with symbol NU. And both Melli and NU are in Latin America, which is considered less risky than Kazakhstan. However, I don't think that Kazakhstan is that risky that it should have a tiny valuation compared to Latin American companies. The next company is PEGA Systems with symbol PEGA. They are an AI-driven decisioning, workflow automation, and customer engagement platform. Revenue in the quarter was 476 million, up 44% year over year, and that's with strong profitability of EBITDA of 130 million and net income of 85 million. Subscription licenses were up 195% year over year, but other metrics seem low and don't make a whole lot of sense to me. ACV grew 13% year over year, and their backlog grew 21% year over year. This is with operating free cash flow growing 13% year over year and free cash flow growing 13% year over year. The metrics seem a bit lumpy when I look back a year, and I struggled to put together the pieces on the numbers they're reporting. And that's pretty unusual for myself to not really be able to put together the pieces or understand how these numbers are coming together. So that is a bit of a yellow flag from my perspective. But it is worth keeping an eye on this company as they seem to be delivering strong results. We also took a look at CyberArk software in the month with symbol CYBR, and they are an identity security platform that's competing with the likes of Okta and CrowdStrike. Revenue is 318 million, which is up 43% year over year, with EBITDA of 12 million and net income of 11.5 million. The market cap is quite large, though, at 19.3 billion. The company did beat their guidance fairly well, but the sequential guide would mean 3 flat quarters in a row. So I'm not sure why the revenue is not accelerating too much quarter over quarter. There's two recent acquisitions for this company, and they don't break out the revenue, which software companies typically do. There was Zilla Security, bought for 165 million in February 2025, and then Vanifi, bought for 1.5 billion in October of 2024. The main cons I see for this business is that it's already fully mature with a 19 billion market cap, and they have 4,000 employees, 1,600 who are in sales and marketing. And I see this company as a business that's fully recognized by the market. For these next companies we researched, the thing they have in common is they're all Canadian companies. And I discovered a number of promising Canadian companies in the month. The first of these companies is NTG Clarity Networks, with symbol NCI.TO. They do software and IT on billing, ticketing, logistics, and inventory services. Revenue was 13.7 million, which was up 68% year over year, with EBITDA of 1.8 million and net income of 1.4 million. They have a pretty low market cap of 94 million Canadian. And one interesting thing is that 95% of the revenue comes from Saudi Arabia. That's definitely a dark yellow flag for me, or maybe a red flag, but it is interesting. This company's growing and they have a really good relationship with the businesses in Saudi Arabia expanding there. And I learned that Saudi Arabia is going through this big digital revolution as well. The company does have a fairly low gross margin for a software company of 38%. So that would be something to look into about this company. Our next company on the list is called VitalHub with symbol VHI.TO. They build software for electronic health records, workforce automation, and a patient engagement platform. They had 15.1 million of revenue in the latest quarter, which was up 42% year over year. That's with EBITDA of 2.6 million, net income of 0.8 million, and over 80% gross margins. The company has cash of 91 million, zero debt, and the market cap is 617 million Canadian. But with just 15 million of revenue, this company doesn't seem too cheap. They do have contracts with the NHS from the UK for their platform. My big concern was that management absolutely loves merger and acquisition, and they seem really happy to be acquiring other companies rather than just building their product organically. Another company we looked at was called NEAT.com with symbol KSI.TO. They are a validation platform for life sciences and pharma, and they have a no-code or low-code system. Revenue was 10.2 million, up 37% year over year, but they did have negative EBITDA of 0.9 million and positive net income of 1.5 million. The company has a 74% gross margin in their latest quarter. My big concern here is on valuation. It seems pretty steep with a market cap of 627 million Canadian and just 10 million of quarterly revenue. The last Canadian company I looked at was ZOMD Technologies, and I'm not sure how to pronounce that, ZOMD or ZOMD, with symbol ZOMD.V. They're on the TSX Venture Exchange, which is kind of like the pink sheets for the Toronto Exchange, but it's easier to uplist than the pink sheets to NASDAQ. They offer performance marketing solutions, and they have some customers like the apparel company Fanatics. Their solutions are for user acquisition, and a mobile data service provider connects advertisers to exchanges and networks. Revenue was 18.2 million in the latest quarter, which was up 108% year over year. And they have strong profitability. EBITDA came in at 5.2 million, net income at 4.8 million. The market cap for this company is 121 million Canadian. The headquarters is actually in Israel, but most of the revenue is heavily concentrated in Canada. And I do think this company has extremely attractive economics on the business with 18 million of revenue, and the market cap is only 121 million, but they are getting nearly 5 million of net income in the quarter. So this company seems very undervalued to me. Let's now summarize our month in review. We had really strong results, which was heavily driven by Sezzle, a top confidence position now. Companies like Reddit had a nice recovery in stock price as well, and the company Paysign has been performing well in the portfolio. The four companies we mentioned in the alternative banking sector are performing really well. Three of them are in our portfolio, and one is on a watch list. These include Sezzle, Paysign, Dave, and Propel. Our portfolio is more balanced now, but we have 12 stocks, and that's more than we typically want. I usually recommend 7 to 11 stocks. I would ideally like to get down to about 10 stocks by selling one or two, but I'm not going to force that aspect. I'd rather wait and see a company either disappoint me or learn something new about a company and cause me to sell it. The next strategy video I'm planning is how to investigate a new promising company. And we'll examine the steps we take once we gather a symbol from a screener or we hear about a company, possibly from another investor or another source, and then we want to investigate it. This concludes the summary for the month, and if you enjoyed the video, subscribe or leave a comment below. As a last reminder, this is not investment advice or recommendations to buy any stocks. Thanks.